So let me say, I think household finance has grown enormously over the past 20 years when I started working. And a lot of the work, I mean, I think of household finance when it kind of started out as something looking for anomalies. Oh, these are mistakes. And so it was more analogous to what asset pricing people do. And over time, it has become more analogous to corporate finance and saying, oh, these are the theories. And let's see how we can look at household behavior similar to corporate behavior that is aligned with theory. So I've seen the transformation go moving from that. And that's what I have been kind of also doing. I started out saying, oh, household finance and look at anomalies. And I've been specifically more focused on policy impact evaluation. I think that's a very important job of economists to do is look at these policies. For example, in the healthcare sector, replacing of Obamacare, this has been going on and discussed for last 4 years. Trade, environment, national defense, banking regulation, COVID, one belt, one road. If I look at India, demonetization, GST reform, there are tons of policies on a regular basis that are being discussed in the popular press, and they clearly have implications and impact on people's lives. So we care about fiscal policy, monetary policy, regulatory policy, even corporate or state and local government policies that will have a direct impact on ours, direct or indirect impact on our lives. Let me name it just few more directly: tax cuts, tax exemptions, monetary policy, money supply, interest rate changes, QE effects, Dodd-Frank, Card Act, Camel ratings, minimum wage changes, which is regularly in the press. And every time we're talking about what the minimum wage changes will have implications on anti-corruption reforms in China, the big demonetization exercise in India. Ideally, if these policies were done correctly, I don't think we'll need to think about, as economists, we'll have to spend a lot of time because the counterfactual will be right there and we'll be able to make causal inference about the change in policies. Obviously, it's not true. The policy makers cannot design policies keeping economists in mind and running some RCT around them. They have all kinds of political considerations. Policy making is like making a sausage. It's always complicated. If I just think about the HAMP policy in the US, it had huge political implications, and Republicans and Democrats were trying to make sure that there's no moral hazard, they are catering to the poor people. And as a result, the whole policy was a hodgepodge. I'll discuss some of that. If we think about any other policy, let's think about TARP policy. There were lots of economic considerations. Should we give TARP only to the banks that are actually in trouble? But if we do that, we'll be identifying who the banks are, and that will create problems for those banks' share prices. So let's give TARP to all these banks. That way we can hide the really troubled banks. So by design, they couldn't actually design the policy to give the money to the really troubled banks. So the field has really grown in household. I remember when I started working in household finance, maybe almost 20 years ago now, there were maybe 4 or 5 people working in it, and we would just discuss issues that are most relevant. And as I said, we would think about mistakes households make. I mean, I started doing this and I would say, look, this is a mistake. And people will say, oh, this is really peanuts. Who cares about this small mistake that you are thinking about? And over time, we have become much more about, let's look at household behavior that is consistent with basic economic principles. So we have moved more to what I would think about corporate finance than to asset pricing. But because of data limitations in the past, we really could not do much in household finance. We could look at aggregate data. We could only look at survey data. And then within survey data, we all knew it was mostly a cross-sectional. We know survey bias issues. But we have seen in the last at least 10 years, there has been an avalanche of data. The private sector has been more than happy to provide their data. You think about the Chase Institute, the Fannie Freddie have started making their data publicly available. So there are lots and lots of agencies, both government and private sector agencies, that have allowed us to then advance this field significantly. So the combination of data availability, policy changes, and economists being interested in understanding how this impacts household behavior has really created a growth in this field of household finance. So what I intend to do right now in this talk is to spend a few more close to like 60 minutes to talking about the various policy changes and its implications specifically in three areas, which is consumption, which is a very important aspect of household finance. Consumption is also a very important macro issue because 70% of GDP is driven through consumption. Housing, which is another very important factor of household behavior. And I'll also talk about some other issues like corruption, because that I think is an important issue globally. And I will then discuss various sub-policy changes around the world that may be impacting consumption, housing, corruption. I'll talk about Bush tax rebates, tax rate changes in Singapore, policy changes in India, Turkey, China, Singapore, so all over the world. And then I'll tell you what are the implications of these on household behavior. Okay, way I think about it, to really be successful in publishing today in household finance, you need some great, amazing data. Obviously, you need some identification, and most importantly, a very important economic question. The economic question to me is essentially coming from a lot of these policy changes and looking at the impact of these policies. So if I go back to the consumption itself, the consumption theory is well laid out. There's a lot of debate in the consumption theory of what constitutes an income shock and what income shock should do to your consumption response. So the way I divide it into is anticipated temporary small income shocks, and anticipated permanent income shocks, unanticipated temporary shocks, unanticipated housing wealth shocks, and anticipated permanent large income shocks. So I'm going to go through each one of them and discuss how do they impact consumption, and then also look at other monetary policy shocks in other countries like Turkey and in China. So I'm going to try to build a kind of a argument that I'm making, showing you these kind of things. So here I will kind of outline the strength of the data and also the research question. So let me start going back to 2000 when President Bush campaigned on a tax cut. This is analogous to what, if you look at Biden is saying also, I'm going to raise the taxes of people who are making above $400,000 and corporations. So you can think about that's a policy change he intends to make if he's president. Question is what will be the implications of that policy change if you increase the tax of the very rich? Maybe you will say, oh, there is going to be no change because the very rich, if their taxes go up, their MPC out of these tax changes will be zero. So we'll not lose anything in terms of GDP growth in the US. That's a question to study. Does it have an impact or not? Going back to the Bush tax cut, he had actually said we'll give rebates of around $38 billion, which was around 2.2% of the consumption in the third quarter of 2001. The average household in the US at that time was going to receive around $500 in tax cuts, in some tax rebates. And so what I wanted to study is what is the implication of this? Standard theory would suggest that actually consumption response should be zero. So we collected this data set from a bank in the US of their credit card usage. The good thing is we had the second to last digit of their social security number, which is a random digit that allowed us to essentially study this in a very clean setting, because the way the tax cuts were given out, the Bush tax cut, they were actually tied to that digit, and some people got it in April, May, and June. And so we were able to kind of essentially look at that cleanly. Here is the main result from that study. I want to explain this a little bit, because if you pay attention to the payment, so this is the impulse response of those tax cuts 9 months out, you see that people immediately when they got the money, they increase their payments. There is a increase in the payments in the first 3 to 4 months. The spending doesn't go up in the first 3, 4 months. It goes up slightly, but then after the fourth month, the spending starts to pick up. So essentially what consumers were doing, they were buying themselves liquidity by paying off their credit card or increasing their availability of their line of credit and then going out and spending it in the subsequent months. You can also see that kind of reflected in the change in debt. Earlier, they were paying down debt in the first 3, 4 months, but after that, when they have paid off their debt, they have a now clean line of credit. They went out and actually spent the money or raked up debt again. What we find is that essentially they spend around 70 to 80 cents of every dollar they received in the Bush tax cuts. So that itself is amazing that we were able to analyze it. This actually was helpful when Bush gave a tax cut again in 2007. I used to be at the Fed at those days. And then we were able to use these estimates in our macro models that we were building at the Fed. So you can see right away, we were able to do a study, look at the implication of that study and use it in policy making in a few years after that. Another policy that is very important in the US and it's a constantly in the news is the minimum wage changes. Every state, every year will have some small changes in the minimum wage, maybe 25 cents, maybe $1, and they're constantly kind of moving upwards. The question is, there's a debate on what is the displacement effect of the minimum wage change. I was not interested in that question. I wanted to understand, does it affect the poor people who are getting minimum wage changes? What is the implication on their spending behavior and debt? So we could look at the CEX data. We also used the proprietary banking data, but we were able to actually study this just using the CEX data. And you find that when they get the money, the consumers who actually get this minimum wage increase, they go out and actually spend most of that money. They spend actually their future increase in paycheck as well. They spend it right now. They increase the debt, they borrow from their future selves to essentially buy durable goods. What we found in the data that a lot of these consumers were buying used cars, which may be around $2,000 to $3,000. And these cars were useful for their ability to transport themselves to their office, to their workplace. Let me talk a little bit about a different policy change. So in Singapore, the Singapore government actually had an unanticipated policy change, which was announced on, say, February 18th, 2011, which they said, okay, every Singaporean will essentially be getting around $400 to $600 in tax rebates from the government directly deposited into their checking account. So every Singaporean who was above the age of 21 was kind of eligible for that. So unanticipated policy change has different implication on as in economic theory. So we wanted to study now unanticipated, whereas the Bush tax cuts, which were well anticipated, well debated before he even became president. So for this Singapore policy change, we collected a data set from DBS, which is the largest bank in Singapore. And they actually cater to 80% of the entire population in Singapore. We got a data set of around 180,000 individuals. The data set spanned around this policy change itself from 2010 to 2012. Now, compared to the previous data set that I mentioned using Bush tax cuts, here I was able to collect credit card data set and their debit card and their checking account information at the same time. So not just credit cards, but debit cards. This is important because we'll see the dynamics of credit and debit usage. Secondly, we were able to get transaction level information in here, not just the statement. So in the Bush tax cut data, I was just able to look at the monthly statement level data, and I was looking at what was happening at the monthly level. Here, I know exactly when you went to Starbucks, you bought a $4 coffee, and on what date and at what time. The data is also rich in other dimensions, but that's not important. What's important is the nature of the data set using credit and debit, and also the transaction level. In the paper, we go over the identification strategy in more in depth, but in this talk, I'm going to just kind of be very brief about it. We just looked at the foreigners who are as our control group and the Singaporeans who are treated. And then we wanted to look at what is the implication of this unanticipated tax rebates given to Singaporeans. This is kind of a definitive kind of graph or parallel trend graph. You can see the treated group, which is in red, and the control group, which is the dotted line. You can see after the announcement itself, which is at time 0, the two lines kind of start diverging, but also after the treatment, which is when actually the money was given out. So the announcement happened at time 0. At month 2, the money was actually delivered. Let me kind of go through this table because this table kind of outlines this in a more clean way. So let me focus on panel B right away. Here, what you see is total spending during the announcement went up by 7 cents for every dollar they received during the announcement, and around 8 cents for every dollar during the disbursement. Now, the announcement time period is 2 months, disbursement is around 9 months. So essentially, you can see that MPC of this is around 90 cents for the dollar. So every 90 cents for every dollar they got, they actually spent it. But the interesting thing here is in the debit and credit. The first thing you will see is that there is no spending response on the debit card during the announcement. All of that is happening on the credit card. Obviously, they didn't get the money, so they don't have that money, so they didn't go out and spend it. They can't spend it on debit, so they spend it by borrowing from the future on their credit card. But as soon as they started getting the money, which is during the disbursement, you can see the spending on their debit card goes up and the spending on their credit card also remains the same. So the dynamics is important, how people switch between debit and credit card, between the announcement and between the disbursement. Why is this important? Because if I go back to the Bush tax cut, I didn't have the debit card spending or any other form of spending. My MPC there was obviously 0.7, but if I could estimate even their spending on cash or debit, I would have found a higher MPC in the US case. So missing data itself kind of can tell you that this is an underestimate that you are doing for the US. Other people had looked at the US and they found there was significant spending on cash as well. So the richer the data gets, the more important and more interesting stories you can think about. The other aspect of this data was that I actually had—
Sumit,
yes.
You've got a question which you may want to answer now or later. Do you think that the results of your studies can be generalized across countries, or what would cause the results to be different?
It's an important question. I mean, every journal editor, a referee will bring these kind of things up regularly, routinely, especially if you're looking at a country like Singapore. They might say, okay, that may be very specific to Singapore. That's why I'm abstracting away from any specific things on Singapore. I'm just saying, look, here is money received, and the only instrument I'm going to care about is how it was spent, debit, credit, or where it was spent, which is very much what I do for when I will go show you some other studies for China and some other studies that I've been working lately on the US around, around the housing policy change. So these results we will carry through almost anywhere else. I'll show you some other work I've done on India as well. Okay. So the other point I want to emphasize is the strength of the data, because earlier we were using the monthly statement, but in this study we were able to use the transaction level data. Every transaction I could see where you spent it. So this allowed me to see where the money went actually. What you see is most of the spending was happening on travel, apparel, durable goods, and entertainment. But other goods, dining out or services, there is really no response. So this is again the strength of the data, but also it helps policy because you can see where we can target these kinds of tax cuts or tax rebates to help the consumers. Okay, let me move on to think about not just income shocks, but maybe there could be wealth shocks. So here we exploit another quirk in the Singaporean policy, which was that in Singapore, when you buy a house, they essentially force you to live in it or hold that house for 3 years, and before you can go out sell it. The reason is these are government subsidized housing that is being provided to the households, and they don't want you to go out and immediately think of that subsidy and cash it out and spend it. They want you to actually be living in these houses, okay? But house prices were going up, and so the government was a little worried about it. So they said, we will increase the minimum occupancy period from, say, 3 years to 5 years. So what do I mean by that? Let me give you a simple example. Let's say house prices are increasing by 40% between 2007 to 2010, and somebody bought a 4-bedroom apartment that cost around, say, $278,000 in 2007. And there was obviously this 40% housing wealth gain. So their housing wealth would have increased by, say, $114,000 during that time period. But now, so one scenario is I realize that I have actually this wealth gain of 114,000. Now I can go out, sell this house, and spend part of this money for consumption purposes. But policy came out in 2010 and said, no, you cannot sell it anymore. You have to hold it for another 2 years. So that I have this wealth that I can't realize. So this option to realize is not there for my wealth. Then the question is, what happens to their spending after the announcement of this policy? Will this cause me to cut down my spending? It will have to, because I was literally borrowing from my future self in anticipation of selling this house and paying off the debt. Now, if I can't cash it out, what will happen? So then we looked at your spending behavior across debit and credit, and then we found that your spending actually drops by 20% on your credit card. Nothing on the debit card. That would be exactly what we should anticipate, because you were borrowing from the future self on your credit card to spend today in anticipation of actually selling this house and paying off your credit card debt. Now you can't do that, so you'll have to cut down that spending. Debit card spending is actually spending that you have cash for, and that should not be impacted. Question then is where that spending cut will happen for you. We looked at discretionary versus non-discretionary spending, and we find that most of the spending cut that you will do, or pretty much all of it, will be in your discretionary, because you knew you were getting this windfall in your wealth, and you went out and bought things, indulging in the handbags or vacation packages, all of the discretionary spending. That's where you will end up cutting it. If I look further in detail, which kind of discretionary spending you will cut down: entertainment and apparel. So those are important categories. That's where people were spending this money on, and this is where we see them cutting down their spending. So again, you see a couple of scenarios where people were either getting a shock, a positive shock, or a negative shock, and you can see how they actually change their behavior. Let me spend one more study talking about now a totally different group, which is the retirement group. What is happening to the older age population when there is a policy change? So again, I'm going to focus on this maybe last policy in Singapore, where we look at age 55-year-olds who actually had this option at age 55 to withdraw their retirement savings from their bank account. This is analogous to also what happens in the US. You can actually in the US withdraw your 401k savings almost at any time. You can withdraw it. You have to actually return it back to the 401k with interest on it. In Singapore, they don't allow you to withdraw it anytime, but at age 55, you can literally go out and withdraw around 20% of your retirement saving. So if I think about generalizability again of this argument, it's fairly similar to what happens in US, but in the US, you can't get identification to study this question because it's endogenous when you can withdraw it. In Singapore, it was much more of a policy change, so it allowed me to kind of cleanly see what people do with this money. So what happened in 2009 is essentially the policy was you can go from withdrawing 20% to essentially withdrawing 30%. So that 10% additional withdrawal, and then we wanted to study what people do with it. The first graph, or graph A, shows you that withdrawals goes up. They go up from 0 at time -3, -2, or -1 to around $15,000 they withdraw as soon as they're eligible to withdraw their money. That's first evidence that people withdraw it and they put this money in their checking account. Once I start looking at their spending behavior, there is essentially no effect. They only spend $500 out of that $15,000 they're withdrawing. If I look at their credit card debt payment, they're only paying down $500. So they're withdrawing $15,000, but they're only spending a total of $1,000. 500 is spending and another 500 is paying down debt. What you can see is even after 12 months, $10,000 of that money is sitting in their checking account. So that's kind of interesting pattern because they earn 0% in their checking account, whereas if they left it in their retirement savings account, they will be earning around 4% risk-free. Okay, we can do something more fancy in looking at where this spend is coming from. But to me, this was interesting where this money went, and they never actually put it back into their retirement savings account. Why am I showing you this? We were actually doing this study. We went back to the government. We were showing this results to them, and we saying, look, a lot of this money is just sitting out there. And the government said, okay, this makes sense. Then let's reverse this policy change. And they reversed the policy change, and they brought that back down to 10%. So you could only withdraw 10%, not 30% anymore.
Okay.
So you can actually see that. Yes.
A couple of questions. One is from Rena. Do you think this would vary based on the savings rate of the country?
Clearly, I mean, what was happening in the Singapore's example is obviously the savings rates are very high, so people's behavior will be different. In the U.S., we have seen people who are withdrawing from their 401ks. They're actually, so David Leibson has been working on this for the last 20 years, this issue, and he has documented people's spending or lack of savings there when they withdraw from their 401k accounts.
Okay, I've got a question as well, which is, it seems like if we go back to the last slide, it seems that what's happening is that people are giving up 4% from their retirement accounts, and they're putting a large part of that into reducing the debt, credit debt, which presumably they're paying more than 4% on that credit debt. So it seems like there's a bit of an arbitrage there for them in making that decision.
They're only paying down $500. They're withdrawing on average $15,000 from their retirement account and only paying off $500. That is all very good because your credit card debt is at 24% and your retirement saving is at only giving a return of 4%. That I'm very happy with. But even after 12 months, $10,000 is sitting in their checking account. And that is what I was kind of worried about, that why are they not leaving? They need to pay down credit card debt. They should only withdraw what is needed for paying down debt.
Okay, unless I guess it could be precautionary liquidity type thing, or possibility of maybe considering purchasing some real estate at some point in the near future?
These are 55-year-old people. They could. We actually looked at that in depth in the paper. So okay. I'll not talk about it now, but yes, we looked at all these other scenarios on because they use it for precautionary motives is one of the most important one. Could be health related, could be related to paying off, helping their grandchildren go to school. So we can actually follow the money where it is going. The amazing thing for me was it was going nowhere because it was sitting in their checking account most of the time. Even if I extend the time period for 2 years after that, the money didn't leave the checking account.
And getting no
Let me
interest.
move on to thinking about monetary policy. So far, I was talking about fiscal policy change and housing wealth policies. Think about monetary policy. So studying monetary policy is actually very difficult because there are lots of hurdles. Let's think about in the US case. If I want to study what will happen when monetary policy changes, the impact on consumer behavior. So there are 3 steps. When monetary policy change, it will have to be impacted through the banking channel. So the banks will have to then reduce the interest rates. Once banks reduce interest rate, then people will have to go refinance their mortgages. So they will reduce their debt service burden on their mortgages. When they do that, then they will have to go out and spend that money. So there are essentially 4 steps you'll have to follow through. Lots of hurdles. Will the monetary policy pass-through happen by the banks? We don't know. There's long literature. It's debated. Does it happen or not happen? Secondly, will refinancing happen? I worked on it and we found only 10% of the people refinance their mortgages when their option is in the money. So all these hurdles make it very difficult to study how monetary policy changes work out in terms of spending behavior in the US. Even though I'll present some evidence of that later on in the slides. But what you can do this easily is in China. In China, they announced a change in monetary policy, and automatically it reduces your mortgage interest rate by 2.3%. And not only that, they automatically refinance your mortgage. So it's not that you can choose to refinance or not choose to refinance. Everybody gets their mortgages refinanced when mortgage interest rates drop. So I don't have to kind of worry about selection of who is being selected into reduction in mortgage rates, refinancing of their mortgages. Then I can have a much cleaner experiment where I can see what happened to mortgage interest rate reduction that reduces your debt service burden, and how did you go out and spend, and what did you do with that money? So we went and collected a data set from a Chinese bank, which is one of the largest Chinese banks. And they were able to match this data not only with their mortgages, but also with their other banking instruments like their credit cards, debit cards, and cash. What we find is that there is a significant consumption response of the money that these people are getting because of the reduction in the debt service burden. So their debt service burden went down by essentially significant amount because the interest rate reduction was 2.3%. So they spent during the announcement and after the reset of their debt service burden. So in China, the way the policy works is if the announcement happened in, say, September, all the resets will happen in January only. So there is a significant time period between the reset and announcement, but people anticipate that a reset will happen. So they just go out and start spending it even during the announcement period. We also see that delinquency goes down, which just kind of makes sense. People were spending more money on their credit cards or other instruments, but now they anticipate money will be coming in. So their delinquency levels will go down because they can pay off their credit cards and other things. Another policy instrument I looked at was in Turkey, where there was an unanticipated interest rate shock in Turkey, where they increased their lending rate from 7.75% to 12%. So it's a dramatic change in interest rate, increase in interest rate by almost 5%. So the question is, when monetary policy interest rates increases, what happens to deposits, withdrawal of money? So the idea was on this money demand literature that talks about that demand for money should go down because holding cash now is more expensive than leaving the cash in your bank account. And that's what I wanted to test. Does the demand for money change for you when interest rates will go up? What you find is that, yes, now here, it's not as clean as in China because there we actually knew a treatment and control group. So here we had to work a little harder to think about the treatment and control group. I can spend a minute just discussing that. So we thought about how should we create a treatment and control group. So we actually took advantage of the religiosity of the people in Turkey. And we said people who are religious will actually not be abiding by this policy because they really don't care about changes in interest rate as advocated by the religion itself. So we said, let's look at their spending behavior, on their transaction behavior during Ramadan, and if they're buying alcohol or tobacco or anything else, or they're buying food items during the day, or so they are not as religious as they should be. If they are not religious, then we'll say they will actually care about the change in interest rate, whereas the religious people will not. So we created a treatment and control group in that way. And what we see is that the people who actually are non-religious, when interest rates go up, their demand for cash or their withdrawal from for cash from the ATM machines actually drops by around 127 lira, or around 8% drop in withdrawal for cash, just because of interest rates going up or monetary policy changes. We can also look at their credit card and debit card spending. We also see similar evidence. Their spending goes down by around 12%, which is around 46 lira on a constant average of around 380 liras. So they not only withdraw less cash, they also cut down their spending, because now spending is more expensive today relative to tomorrow because interest rates are higher. They'd rather earn higher rates on the check in their bank account and substitute away consumption from intertemporally. So these are a bunch of studies where I looked at how policy changes, monetary policy changes, fiscal policy changes, and even housing policy changes and its implication on spending. So you can see there is a very rich and fertile ground for us to study this. I'll spend a few more minutes talking about housing, real estate policy. Here I'm going to focus mostly on the US. Because the US had a bunch of regulatory changes, CRA, HAMP, and HARP, and then discuss a little bit on corruption, and then I'll be open to question and answers. You can also obviously ask me as we go along, and you don't have to wait till the end. Okay. The HAMP program in the US during the financial crisis was an important program. It was hotly debated among the politicians who should get the HAMP program. Essentially, the HAMP program was giving money to the consumers so that they can modify their mortgages. This will allow them to stay in their houses after them being delinquent, as opposed to them being kicked out of their houses. Okay. In the US, where 5 million houses were in foreclosures in 2007, and 20% of the borrowers owed more than the house. So they were definitely deep in the money to default on their mortgages. So we wanted to study, does the HAMP program, which is again a policy change, help consumers to stay in their houses? The HAMP program had two criteria, the eligibility criteria that allow us to kind of create this counterfactual or create a treatment and control group. Specifically, they had this criteria that the HAMP program, you will only be eligible for it if you are owner occupied and not an investor. And the second criteria they had is that the loan has to be below 729,750. I have no idea how they came up with that number, but that was the number that the government had, that if you're above that, you can't qualify for the HAMP program. If you're below that, you qualify. So essentially, we used both of these selection criteria or eligibility criteria to show, was the HAMP program effective in the US in getting people to stay in their houses, or did it reduce redefault rates in the US? If I just look at the FICO scores and interest rate across these two groups, the treatment and control, I can define it either way, either through investor versus owner occupied, or using the $729,000 cutoff. You can see that the interest rate and FICO scores are very similar of both these groups. If I look at the interest rate that both of these groups were paying over the time period, They were very similar. So I think the validation of the design is there. What you actually see is the take-up rate or the modifications through the HAMP program actually jumped up quite a lot during that time period. So the HAMP program was actually effective and working in getting people to for its take-up. The one question that people may have right away is, look, the HAMP program, you see eligibility there and people take-up rates going up, but that may be killing the private mods program because the banks were also doing modifications on their own before the HAMP program came about. Here is a graph that kind of shows that the private mods program actually did not change at all. The banks were not substituting the HAMP program to the private mods program, and that's why we saw the HAMP program go up. So essentially, these were two different kind of borrowers they were giving modifications to. So the point takeaway from here is, if I look at the HAMP program, it was very effective in getting people to get their modifications. We do a lot more there. It's in the paper, but again, I'm just picking few slides of each of these studies to convey the main message and to show how we can do policy impact evaluation. CRA is another very long-standing program in the US, hotly debated for the last 30 plus years. People have been saying, is it good, is it bad? What are the implications? Here, I didn't want to look at directly what is the impact on consumers, but indirectly, how do banks respond to the Community Reinvestment Act, and what is the implication of that on households? So here we think of a different way or different strategy to come up with a treated and control group. Essentially in the US, what happens is every 18 months, there is a CRA exam that a bank has to go through. And we wanted to study during the CRA exam, do banks change their behavior relative to control banks who are not being examined, and see how they change their behavior in terms of lending. Do they increase the lending to households while they're being examined by the regulators? What you actually see in the data is they increase their lending to CRA census tracts and non-CRA census tracts, especially who are CRA qualified people in the non-CRA census tracts. So this shows you that lending actually increases by the treated banks who are being examined by the regulators during that time period. What you also see is the lending the banks are doing is actually risky lending. So there is higher default rates of the borrowers during these exam times. This is where I come in and I think about this has implications on households, not just bank behavior, because they are giving loans that they shouldn't be giving, or effectively hurting the household's credit score ratings and balance sheet. Here's another program, which is the HARP program, which was also hotly debated, which is a refinancing program. The government was saying, look, people are actually underwater, they're delinquent. How do we get them to stay in the house? Let's see if we can get these people to refinance their mortgage. This will reduce their debt service burden. If it reduces their debt service burden, they could go out and spend some of this money. That could have an implication on the GDP, and it will help the US economy. Alternatively, if they reduce their debt service burden, they will have more free cash flow that they can use to pay down their mortgages. So either way, it is a good thing if we refinance their mortgage at a lower rate, because in 2009, interest rates are very low in the US. It's a very important program in the US. And the question was, did it work? This is analogous to what I presented earlier in the case of China, where all of this happened automatically. But in the US, it's not obvious. First, will this program work? Will people refinance? If they refinance, will they go out and spend this money? Will they go out and pay off their debt? Maybe the banks may also have ulterior motives. The banks may actually not allow you to refinance, and they may create some hurdles in your ability to refinance. And essentially, that's what we see, that banks effectively don't allow borrowers to refinance. They take away most of the money essentially, because there's this G fees involved in refinancing. If your interest rate reduction was around 1%, 40 basis point of that was essentially being taken up by the bank in this scenario. This is the example I have. I'll skip this. I'll kind of talk a little bit more on corruption and how corruption policies may have implications on spending. And then essentially, I'll try to stop and entertain questions. Okay. Here I wanted to see if during the mortgage crisis in the US, were banks actually delaying foreclosures in the districts of the House of Representatives who were working in the Financial Services Committee? So you think about Dodd-Frank was being debated hotly in the US in 2009 and 10. And obviously all these congressmen coming from various districts were on the committee. So do the banks endogenize that fact and then say, let me reduce the foreclosure rates in the districts of these committee members so that they can water down the will because they don't think this is a big issue, so they will not be as strict on us. That was the question I had in mind, but I also wanted to understand what's the implication of that on households. I mean, obviously, if they reduce the foreclosure rate, households will be better off. Okay, so what we actually find is that banks clearly realized this thing, and they were reducing the foreclosure rates of the committee member districts. Huge implication for consumers. We do a lot of things in the paper, but right away you can see it has implication to household. Let me talk about another study is, do banks essentially give a credit line premium to bureaucrats versus non-bureaucrats? Here we look at a study that we did in China. We were looking at a large represented sample of consumers in China and seeing, do banks kind of have some disguised corruption motives to give larger lines of credit to bureaucrats and smaller lines of credit to non-bureaucrats? This has implications on household behavior, because if they're unconstrained, the banks are unconstrained in their ability to give credit, then I don't care, even if it is corruption. But if they give higher lines of credit to bureaucrats, but that impacts their ability to give lines of credit to non-bureaucrats, then obviously there is welfare implications. The non-bureaucrats' ability to consume and spend is being reduced because of the corrupt practices of these banks. What we find is the main results that the banks on average give around 16% higher lines of credit to bureaucrats. The study is done fairly carefully. We have some identification in terms of a policy change of anti-corruption policy in China, and we can show what that anti-corruption policy was doing in terms of reducing their ability to give these lines of credit to bureaucrats. Another study I was doing was in India. Demonetization was a big exercise in India. The question was, everybody was saying all the money in India after demonetization actually came back into the banking sector. How did it come back? So in India, there were two policies that happened almost back to back. One was demonetization, and the other was giving bank accounts to the poor people. That was called the JDY. And what that gave is around 400 million bank accounts were created in India for the poor. So what we were trying to understand is, during demonetization, did the corporates or did the small business owners give their cash to their employees and ask them to deposit that into their bank accounts and over time return it back to the business owner? So in some sense, I'm trying to understand how demonetization worked through corrupt practices of these businesses. So you can think about what was happening. A business owner keeps a lot of cash in their house, let's say 100,000 rupees. Demonetization happens. All of this money is useless. Now they can't do anything with it. So they distributed this money to their employees. They ask the employees to go deposit it in their bank accounts, and then in 6 months or 9 months, give it back to the business owner. But obviously, they will have to give some cut to their employees. And this is what we show in the results, that the JDY account holders got a lot of this money from their bosses, you can think about, but they also spent some of this money, and some of this money was returned to the business accounts. So JDY bank accounts deposits went up. The business bank account deposits also went up over time, but some of this money was spent by the JDY account holders. So the kind of, in some sense, it was a win-win. The poor people benefited because there was a transfer of wealth from the rich. The government lost out because they lost out in the tax revenue they could have collected from this. There are lots more studies I have looked at. I will try to take a breather here and see if there are questions here. And then if not, then I can talk a little bit more about some other policy changes that I've been studying around the world, or I can talk more generally about implications for future research. Maybe I can talk about future research and then stop and ask for questions. These are some bunch of other studies I've been doing. I'll skip some of these. When I think about some ideas for future research, I mean, it's just endless. CFPB, Dodd-Frank, what will happen right now? I mean, CFPB has been gutted in the US significantly. There is a big election happening. What will be the implication of this election on these policies? I've been waiting to look at the tax cuts that Trump did and how that impacted the mortgage interest deductibility above $500,000. That's a very important question. What was the implication of that on households' ability to take out mortgages and spending? The Trump tax cuts, very important question. In the UK, if you look at FCA is making many changes on consumer regulation. If I think of Obamacare and consumer default, how does it impact Obamacare, your ability to actually go and get healthcare? As a result, you don't have to have this precautionary savings motives to, if that reduces, does spending go up? Does credit card default go down? All of these questions are important. If I look in Asia, there is enormous policy reforms are happening. Almost every week you will hear some policy change in Indonesia, Malaysia, China, India. And all of these policies are just ripe for us to think about their implication on household behavior. For instance, what will this do to consumption, housing, spending, savings, investments? All of these are very important questions. I don't want us to just think very narrowly in terms of consumer behavior, in terms of financial outcomes, but more broadly, I think of technological change. If I look at the impact of water policy change, electricity, because not only we think about fiscal and monetary policy changes, but transportation policies. I'm very interested in these issues these days. I spend a lot of time looking at various policies that will impact not just my consumption behavior, but maybe also my behavior in many other domains. Environmental policies. For instance, within Singapore, I'm looking at how housing upgrade policies that actually upgrade all your piping in the house affect your water usage, and that has a huge implication on resource allocation in a country like this.
Sumit,
is a big issue. Yes.
I just wanted to follow up on that. I know that you've been working on one research project that's looking at air pollution in China.
Yes.
And you found some, I think, pretty interesting results that have potential implications for both corruption and probably for health expenditures in those areas. Would you be able to say just a few words about
Yes.
that?
Yes. So that's a very important policy. So what is happening in China, essentially, we were able to collect monitoring stations, so weather monitoring stations data hour by hour. And we have that data for 1,600 weather monitoring stations in China, environmental pollution monitoring stations. And we find that factories increase their sulfur dioxide pollution levels after sunset. And they increase them by around 15 to 16%. So every day after sunset, pollution levels go up in China. That has huge implications on the health. So then what we did is we went out and collected the health data from the hospitals in China. So we have data from around 50 different hospitals. And what we find is that the same evening or next evening or the following evening, next couple of days, there is respiratory related hospitalization rates go up in China for kids and even adults by around 20%. So Chinese who live near these factories are inhaling the sulfur dioxide that is coming out through these factories in the night because they shut down their desulfurization units and causing people to go out and go to the hospital. Huge policy implications. Then we looked at if there were actually regulatory enforcement of this environmental policy, specifically if the Environmental Protection Agency was sending people to kind of monitor these factories, then we'd see a huge drop in sulfur dioxide emission during the nights as well. So again, important policy implication was that if we can actually get the Environmental Protection Agency to routinely monitor these factories, we can save not only the level of pollution there is, but also have huge implications on the health outcomes of the people.
Sumit, we have another question that's come in. Yeah. I would like to hear more about the research process, how you know something is worth pursuing, given that much of what is worth studying may have already been studied in by some other people, and our primary motivation is that we have a different setting than the prior study.
Yes, that's an important question. So the way I think about it, I routinely keep track of many policy changes that are happening. If I can show you my iPhone, I just keep track of all these policy changes. What happens is every week I will go through my iPhone and look at these policies. Some of them I realize after a week, oh, this is not that exciting, or this is a small question. Who really cares about it? And so I'll just drop that question. But if it sticks in my iPhone over a month, then I'll start thinking, okay, this is something I really want to pursue. I like this question. And then I start thinking, what is the right data to use this? What is the way I should think about identification? What is the prior research that has been done? Then I will ask an RA to go and collect some of the research that has been done on that topic. And if I realize, okay, this has been done sufficiently well, my contribution will not be that important, let's just forget it and move on. If I do the research and find that, oh, there is a gap that can be filled, let's pursue this. And this is how then I start thinking, what is the right data? Where would I find the data to kind of really study this? To me, that what is important is you can't just have some average quality data to study these questions. The top journals will not publish it. Even the average journals these days, they just say, oh, we don't learn anything unless you show me the counterfactual or you can make some causal inference. So the bar is very high. I mean, I'd say you need a very good question, you need very high quality data, and you need a clean identification as the bare minimum to write a paper that can publish even in a decent journal, not the top econ, not the top finance journals. So I am routinely thinking about these policy changes, what implications they could have, what is the economic theory that says about it. Let me give you an example of one. So that kind of illustrates this thing. fintech is very important these days. It's a buzzword, especially after COVID. We are realizing that fintech is the way to go. Banks are aggressively kind of taking it up. One form is by actually getting rid of the payment system and getting rid of cash. Now, this is a complicated question. Substituting cash with e-wallets. Now, it impacts three sets of people. The consumers are impacted, the businesses are impacted, and the banks. Because the banks don't want to really deal with cash, they rather deal with e-wallets. But when they deal with e-wallets, they are worried that they may cannibalize their credit card and debit card business. The small businesses don't want to deal with cash because it's cumbersome. They have to go to ATM machines to deposit, withdraw money. So they rather do e-wallets. The consumers are thinking, should I use e-wallets? Should I get rid of my cash or should I get rid of my credit card? So it's not that simple. So here you actually need a model to think through, and then you need to find the right data and the right policy change or introduction of the e-wallets. So this is a question that I've been thinking about for a couple of years. And then I found a policy change. I said, okay, now let's see how we can go out and study this issue. I hope this answers it. I mean, I want you guys to be thinking about small policy changes that could have implications, big implications. I mean, I sit in Singapore and I pay quite a lot of attention to the political debates in the US. I think either one winning will have huge implications to the US. One obviously negatively, one obviously positively. That's my personal view. But that itself should tell you what is important and what is important for us to study. I'll wait for the questions. Otherwise, I'm happy to.
I think it could be interesting to give a few more examples of some of the other issues you've been working on.
Oh, many. So somebody was asking the question, how to get data. So this is also an important question. How can I get access to data? I think most of us are not willing to go ask. We just think, we endogenize the fact, if I go ask for the data, they will say no, so I should not go ask. My view is if I'll ask data from 10 different sources, maybe one will give me the data, okay? And if one source gives me the data, then I can think of many different ways to use it. I'll routinely go ask data for government agencies in Singapore, in India these days. I'm working quite a lot on looking at automobiles in India these days. I'm really interested in when tax policy change happened in India, which was the GST reform, goods and services tax, because every state in India had different tax rates. And the question is, when GST reform happened, what was the impact of that on durable good purchases in India? The story I have in mind is I can essentially go across the border and buy a car because the tax rates may be lower in that state. Did people used to do that before the GST reform in India? And after GST reform, when they have uniform taxation, do we get rid of this? And is there welfare enhancing because tax collection will go up now? Okay. So the question is clear in my mind. The data is very difficult because most of this data is actually publicly available, but I have to hand collect it going by for each different car registration area. It will take me years to collect this, hand collect the data. So I was talking to the government agencies and they kept telling me it's not applicable, we can't give it to you, why don't you hand collect it? After 2 years, finally they said, fine, we will give you the data. So I think persistency is very important. Once you have the question in mind, the policy change is there, you already know the economic question you want to study, and then you just need to keep pestering them that this data will help, it's in the interest of the country. I will actually do some work for you that will help you guys as well to think about it. Finally, they gave it to me. Now I can, once I have the data, Obviously, first question is this on this tax policy change, but then I've also been thinking, do environmental impacts have any implication on when and how you purchase a car? So I have actually the data for India for the last 6 years of every car purchase or every vehicle purchase. It could be a car, it could be a three-wheel scooter, it could be a truck. Every vehicle purchase in India, I have the data. So I can think of many research questions now, but it started out by looking at the GST policy change and how that will impact tax collection in India. I can think of other policy changes that are happening in India, in China, in Turkey. So let me go after another way of thinking about research. Let's think about consumption. So consumption literature, most people will say liquidity constraints are the way to explain who responds to income shocks on consumption. But why should we only restrict ourselves to thinking about liquidity constraint? Instead, I could think about that people have present bias. People who have present bias, they actually discount the future differently, and maybe they will also have a different consumption response to income shocks. Now, nobody has really looked at the data on this, but maybe this is something we can look at. Then your question is, how do I create present bias? Who is present biased and who is not? Think about somebody who has a mortgage, but also has a credit card debt. So if I can actually collect a data set that has both their mortgage and their credit card debt, that will allow me to get at present bias. So that's something, it's a question I'm interested in, but I've been now thinking about how to collect the data that gives me their overall portfolio of the consumer. So I can actually test this idea. Another thing in asset pricing, people have always been talking about, people who have, risk aversion parameters are different. Some are risk averse, some are risk neutral, some are risk lovers. Now, does risk aversion also impact consumption? Another question which we should study, we don't study because we don't relate risk aversion to consumption per se. We relate it indirectly through maybe precautionary savings motives, but not directly. There, I would say the theoretical motivation would be different, but risk aversion. Now, how do you test it? If I can actually collect data on individuals who have an investment portfolio and also their spending behavior, then I can look at their investment data, look at people who have a diversified portfolio versus undiversified portfolio, and then come up with some risk aversion parameters for these people, and then look at some policy change and impact of that policy change on their consumption behavior. So these are kind of questions that are interesting. We need the right data, but we also need to think of the question, think of the identification, and then think about how to go out and collect the right data to study this. This is what I would suggest to all of you guys to think about. What is the right way to answer a question that has not been answered in the past? What is the right way of thinking about getting identification to do that? And then how to go out and collect the right or the appropriate data to do that.
Sumit, it seems like the identification question is a fairly challenging one at times. And it seems like often you pick a particular policy change that's very precise about affecting a certain activity. Do you have any advice for people that might be considering other types of shocks like the GFC or the COVID-19 pandemic in terms of when you can and when you can't use those sorts of shocks?
A very good question. I mean, I have been thinking about COVID. So I used to say a couple months ago, you can write any paper, say COVID blank. You can talk about COVID environment, COVID consumption, COVID anything, okay? And you can write a paper. Now I've seen around, 1,000 papers already out there. The problem is COVID is such a macro shock. It doesn't really give you a very clean identification. So what people have said, okay, I'm going to create a control group, which is 2019 or 2018, similar time period, early 2 months and later 5 or 6 months of the calendar year. And that gives me kind of a diff and diff kind of exercise. and see what is the implication of COVID and on consumption, COVID on investment, COVID on corporate outcomes. And people are actually obviously successfully also publishing the research. But I think you need to be clever in thinking about how you want to use COVID as kind of as an identification strategy. Also, right now, I think the market is flooded with papers relating to COVID. So what I have been then spending my time is thinking about how can I use COVID to make a different point. So I look at some of the work that Raj Chetty has done, where he says COVID actually has implications on inequality. COVID actually impacted more poor people in the labor market, in their ability to save, in their ability to consume, much more, or even their investments, much more than the rich people. I mean, academics like us, we had our jobs, nothing really impacted us. We just could teach from home. If anything, we saved more because we were not going out on vacations, our spending dropped, we were not going out to expensive restaurants. But the poor are suffered much more. So then the question is, how can we actually look at this question? So one way to think about this is, let's think about what was happening in terms of mortgage refinancing. Monetary policy dropped interest rates dramatically in the US during COVID. Now, if monetary policy dropped interest rate, did this create a refinance boom? It should. It has happened in the past. But this is very different. Were the poor's ability to refinance was not as much as the rich person's ability to refinance in the US. And because of that debt service refinancing going down for the rich, do they have more savings now all of a sudden? So that is a well-defined question using COVID.
Sumit, what about the biases in primary, secondary education quality around COVID as well?
Very true.
A lot of discussion about whether you have access to a computer.
Yes. And not something it's not my cup of tea, but obviously a very important question. What is the implication of this on education? I think this is a question people will be studying for the next 20 years, the effect on educational outcomes. Because in the short run, we will be able to see it, but the real implication of this will be in the very long run on people's ability to get education for this year. And these are the kind of questions people have studied in the past in the US, using various reforms of desegregating schools. And they've looked at the long-term implications of desegregation of schools and their high school and college achievement of those children. So very important question. I think some of these questions we'll have to wait for years to kind of study. Health outcomes, we'll have to wait for years. The effect of COVID. Right now we are saying COVID is having a direct effect, but it will have an indirect effect on the lungs that may be persistent for the next 10, 20 years. Something health economists will be after for a long time. So, I mean, I think the questions are enormous, just COVID itself. I think when we were thinking about the financial crisis, people have been writing still after 10 years. COVID will be writing for another 20 years on COVID and its implications on trade, consumption, housing, every facet of economics.
I think what I'm taking from some of your statements in the last few minutes is that you really need to look for a very precise type of impact from your shock. And that's one of the critical ingredients to a successful research paper.
I agree. I mean, I think a lot of people, I've seen this, people will look for some identification that was used in, say, economics, and they will say, can I just transport that over to finance or corporate finance or asset pricing? I think you have to be cleverer than that and just don't say, oh, this will work, loosely work. I've seen those kind of papers, and I scratch my head and I say, this is not good. I mean, this is exactly kind of thinking about what we saw in the behavioral econ literature or behavioral finance literature. Oh, we'll just uncover another anomaly, or we'll just, I don't think that's the way we should think about it. We should think about that right question, right identification, and what is the theory suggesting that we are after. Not just say, oh, I have the data, I have some identification, let me just do something.
Good advice.
I would say for everybody in the audience, think about the smaller policy changes, because those gives the best identification. You may worry that, oh, is this a big enough question then? I'll give you an example of a failed policy change I was looking at. So there was a policy change in Turkey that I thought was very clever or very good because it had macroprudential implications. So I started out using that to work on a paper. I could just never get my head around it. I always knew that the policy is important and interesting, but I just could not see how to kind of write a research paper about it. After maybe a year, I gave up. Then I was having a conversation with a friend. So the way the policy worked was in how much of your credit card debt you can pay off in Turkey. Earlier, you could pay off a minimum payment, but then they said the minimum payment is not good enough because this creates a perpetual debt cycle for the borrower. So we're going to raise the minimum payment that you have to make significantly so you will come out of the debt cycle. I thought that was a good policy, but what they did is they did it in stages, and that kind of made it very hard to study this policy. So initially I had some idea, but then I realized it won't work. Then I was talking to a friend, and then he said, oh, here is one way to think of identification. Then we came back to the question. So again, you may put away a question for a while because you can't do it well enough, but then you can come back to it. So this is what I do. I will keep the questions in my mind or on my iPhone, and then constantly I'll think about, this was a question that keeps bugging me. How can I come back to it? How can I use this again to kind of, or either find better data to solve it, or better identification, or better econometrics to solve it?
We've got another question from the audience. How do you get co-authors outside of the usual channel, i.e. your PhD advisor?
I think I've said this, I say this quite often to my PhD students in class, even my colleagues sometimes, that these days to write a research paper, you need around 3 or 4 people. Somebody who is very good at empirical work, somebody who's very good at writing, somebody who's very good at thinking of the importance of the question, the identification strategy. So like a thinker, like somebody who's very good at writing, somebody very good, and somebody who's very persistent at publishing. A lot of times we can actually write a paper, but then we get the first rejection, and then we just kind of put it away, and the paper never sees the light of the day because we don't have the persistence to publish it. Sometimes you can have these 4 kind of people within the same brain, but sometimes you need 4 different people to do it. So don't think of just your advisor, but think about your colleagues, or if you go to visit a university, maybe somebody's talking about a data set they have, but they have really not thought about the full potential of the data set. But you can give them some ideas, or you may have some data, or you may have some idea, but you can find a collaborator there, and then you can say, oh, let's work together. I'll give you an example. Recently, I was talking to an individual in Hong Kong, and she has collected a massive data set from one company in China. It's a dating app, and she knows pretty much everything that people on that dating app do. The data set is of around 20 million people, okay, on that website. So obviously data is huge, it's very rich, It's so rich, I can't even think about it. So I was just, I mean, I'm not collaborating with her, but I was just bouncing off ideas. Then I was telling her, look, there are certain people you should work with on this data. And I was just giving her a few names who would be ideal for her to collaborate with. But because there was no way I could imagine that she can do justice to the data. She may, but she will be better off collaborating on that data with other people, because that will then fully utilize it in the right amount of time. I mean, if she has in unlimited time, she can use it one project at a time. But if she can collaborate with other people, she can actually write multiple, solve multiple problems from the data more quickly. So again, this was me. I mean, I routinely talk to different people and they will say, oh, I have this massive amount of data from China or from this place. That tells me that the data is available. It's just they are not finding the right collaboration to exploit it fully.
Let me jump in for a second, Sumit, and suggest that another natural group of people to talk to are the other faculty in your department if you're a PhD student. And hopefully in most departments, they're open to you talking to other people. But I think it's also probably wise to make sure that the people you are considering working with are not overcommitted and have a reasonable track record of successfully completing projects.
I agree. I mean, this is another problem I face. Sometimes you pick a very senior co-author and the senior co-author has no time and now you're stuck and you don't know what to do. You can't bug them too much. They have other priorities. And now your project is kind of dying a very slow death. So I think you should not just think about, oh, this is the person who will get me published. No, I think the question is, can I solve the question? Forget about the publication for a minute. But first think about, can I solve the question in the right reasonable amount of time? And if we have solved it well enough, publication should come. Right. So I hear this very routinely from people. Oh, I think if I work with that person, I will get a publication. Just the wrong way to go about doing that.
I would also make another suggestion. If you're working with maybe one person initially and you're having difficulty making a good project develop, then you might want to consider expanding to adding another person that maybe can help jumpstart or shift the direction of the project or give you some new energy.
So I'll kind of add to your comment. A lot of the time, junior co-authors are worried, what is my contribution? Oh, I shouldn't add anybody. I shouldn't have more than 3 authors. I shouldn't have X authors. So this is something that bothers them a lot. And my view is these days, it should not be something you should focus too much on. Look at the science model or engineering. They have tons of people on a paper. What they are very interested in, can we solve a question rather than how many authors are on the paper. It's not the credit you will get is divided by N, the paper divided by N number of authors. No, I think people will see your contribution clearly. Your university will see you, the profession will see your contribution. So I wouldn't be too worried about working with multiple people on the same project or adding people to the project, as Ron just suggested, because that increases your chances of finishing it and publishing it.
I think that's good advice. I've noticed that there's more papers with 5 authors in the last few years, as an example.
Exactly. I mean, because different people bring in different skill sets. I mean, these days, if I want to have a structural model in my paper, my usual set of co-authors don't help me there. So I have to go out of my way to look for somebody who does that. And obviously, they will be on the paper and they provide value, enormous value to some questions.
So I think it's good advice. I think that it's also, I think, very important to try and pick the right set of people and don't just immediately commit yourself to working on a project with someone just because you've chatted with him or her for a limited amount of time. I think some people feel like they're committed as soon as they just have casual conversations.
It's true. I mean, I provide comments on referee reports or just discussions many times, and there is no reason. I mean, that's part of my job as a senior person in the profession, is to comment and give you suggestions. That doesn't mean you should be obligated to me or anybody else that, oh, now I'm obligated to work with them. No, I mean, I'm just doing my job. In fact, I enjoy it. I learn a lot when I'm discussing. So that itself is huge utility to me. I don't need to work with anybody. And that's how I think a lot of the senior people think. They don't need to work with you. They just enjoy the process.
That's right. That interaction, the playing with new ideas. And I think one other angle to this that people might want to consider is when you are looking at where you might take your first job, you might ask whether co-authors get equal credit on publications. I think most schools these days will give equal credit.
Exactly. I mean, it's very important that you are mindful of that at the university. And I mean, I see this more often. Oh, can I work with you because it may help my tenure process? No, that's just a wrong way to think about working with somebody. I think you should work because there is natural collaboration. The banter that you enjoy with the person, or telling them you are wrong. No, I think we can do this better this way, or we need this additional data, or let's dump this project. Those are the things that you should like to work with somebody.
Good advice. I think we're running out of time, if I'm correct.
Yeah.
But let's see if there's any last questions from the audience.
I would also say, guys, I mean, look, I'm available offline. If you have a question, email me. If you're thinking of some idea, if you just want me to kind of bounce back some comments for you, just email me. I will be more than happy to kind of say, hey, this is a good question. This is how you should deal with it. Maybe this is the right person you should collaborate with on this question. So anything, if I can help, I'm more than happy.
Well, thanks very much, Sumit, for, I think, a very interesting session today. And hopefully all the participants appreciated all the insights that you were offering to them. And I must say, you set a high standard in terms of your both the quality of your work, but also the productivity and the breadth of topics that you work on.
Thanks, Ron. I mean, coming from Ron, that is a big praise. I mean, you should all look at what Ron has accomplished over these years. It's enormous, enormous.
It's kind, but I think you outshine me in a great deal. But anyway, I guess at this point, we will close the session.